Todd Sachs of Sachs Realty. I'm the broker and founder here. And tonight we're debuting, sorry about the little glitches here, guys, but tonight we're debuting our Tuesday Night Live. And I'm really excited. We got a special guest lined up, Brenda Evans. But we're going to talk tonight about really, if you have an existing mortgage, this is something you're going to want to watch or listen to, whether you bought 6 or 7 or 10 years ago. Mortgage rates are really low right now. Whether you're a first-time buyer and you're really looking for the proper steps, whether you're a move-up buyer and you don't know how to make that transition, you're in a house that you want to, maybe upsize and your needs are changing and you're not really sure how that overlap takes place. And then you may be a credit repair buyer. So we see that a lot of times. So we're going to talk about that tonight. And if you're an industry professional, you're an agent, especially if you're somebody that's new in the business, this is something that is really going to give you great value. So really tonight, we're talking about how to get the best possible rate for a mortgage and how to pay the least amount for your house, because we know that ultimately your mortgage payment, when you look at the end of the day, when 30 years or 25 years later, when you look at how much you actually paid for your house, your home that you purchased, it's a lot more than you actually paid at closing. So we're going to teach you tonight how to get that absolute best price. So at Sachs Realty, we're really concerned about your best experience, and we really take care of our clients, and our ratings show that. And guys, if you're looking to obviously buy or sell and you're here in Maryland, we'd love to help you with that. If you're outside of Maryland and you're looking to buy, I have a great broker network all across the country. Would be glad to help you and make sure that you're getting the proper care to purchase your real estate. So without further ado here, I'd like to introduce Brenda Evans. So a little bit about Brenda. Brenda and I actually worked together in an office at a previous brokerage before I started Sachs Realty. She rocks. She goes by Brenda the Lender. She's been in the business for actually, I think, over 15 years. And she works for a company called RMS, or Residential Mortgage Services. And guys, her goal is to keep your home financing comfort level high and stressed down. And for those of you that know Brenda, her passion is helping people, and she does so with really high energy and great communication and lots of experience and her attention to detail. And let's go ahead and bring to you Brenda Evans. Brenda, thanks so much for being a part of this first episode of Tuesday Night Live.
Hi, Todd. Thanks so much. I'm thrilled to be here. It's such a privilege. Look forward to bantering back and forth and sharing a lot of news tonight with folks on home mortgages and getting ready to buy a house. It's exciting. It's a huge investment. Some of the biggest investments that you'll ever make are your home purchases. So yeah, a little bit about home mortgages. I basically help people get money in the state of Maryland to make residential purchases. That's what we do, we lenders. And basically the bottom line is, when you speak to your lender, the higher the risk, the higher the rate, the lower the risk of the buyer and the homeowner paying back the mortgage, the lower the rate. It's all risk-based and timing as well when you start to talk about those interest rates. And as you know, we are experiencing record lows, especially when you're buying a home.
Brenda, let's talk a little bit about the home mortgage. So obviously, there's primary market, secondary market, there's banks, there's loan officers, brokers. Kind of give us an overview of what happens when somebody wants to buy a house.
Well, when somebody wants to buy a house, they really just need to make sure they're speaking to a lender that has experience, and it has experience with home buyers. And the local market, and basically, what's the difference? I was listening to a radio broadcast tonight, driving over here on the news, and I heard you need 20% down for a conventional loan to buy a house. And I was like, wow, no way. We've got so many different great loans out there for people. 0% down, like for veterans, for the VA. We've got 0% down for USDA if you're buying in a rural area. And as far as conventional, which is basically Freddie Mac and Fannie Mae, you can put as little as a first-time home buyer, 3% down for a conventional loan. And if you've got good credit, the mortgage insurance can be super low. And then you've got your FHA loans too, for maybe someone that wants to put down money and doesn't have quite as high of a credit score. 3.5% down, 660 plus is perfect for FHA. You're going to get the lowest interest rate. I looked at one the other day, and it was at 2.5%, 30-year fixed for an FHA mortgage.
Yeah, that's crazy. So give us the process. So somebody fills out an application, they have to go through underwriting. What's kind of like the process, and then basically, there's investors ultimately that are buying those mortgages, right? So let's kind of talk about, what happens when, how does a house get financed? Kind of
Right.
take us down that basic road.
Right, sure. And whether you're talking to a bank or a corresponding lender, which is what I am, or a broker, and the difference really is, as a corresponding lender, we underwrite our own loans, and then they get sold and assigned a loan servicer. So either way, the most important thing is that you've got someone you trust that you're speaking to, and someone that has experience, and someone that listens and gets back to you, because it's all about communication, gathering, and exchange the whole way through the process. The more I know about the person I'm working with or the family I'm working with, the better I'm going to be able to help them. And it all starts with the basic. Anyway, we'll get to credit pools and all that, but the bottom line is this: it doesn't really matter what happens after you close as far as who's servicing your loan. What matters is, hopefully a year before you're ready to buy the home, that you're connected with a professional, a realtor, a lender, a year before. I want to see a whole credit profile up front right away. And the secondary market, it goes up, it comes down, loans are bought and sold. That's never going to stop. The most important thing is, when are you ready to buy a home? When are you ready? That's what's most important. The rest of the stuff is going to be up and down.
So let's talk about people. You said that mortgage rates are really low, and they are. I mean, incredible rates right now. Probably some are saying that this is the lowest it will ever be. There's a lot of speculation as what happens next. We're going through COVID. Obviously, there's a lot of forbearances taking place. And, a lot of people are saying that in the next maybe 12 to 18 months, we may see one of the biggest downturns in our economy that we've seen. Something that maybe will even, be greater than the Great Depression. Let's talk about how people can capitalize on these low rates that have an existing mortgage. So for me, for instance, I think the last time I refinanced my house was probably 7 or 8 years ago, and I got like a 4.5% rate. And all the while I've been paying down my principal. Does it make sense for people that have mortgages right now to refinance and take advantage of these really low rates to actually change that principal that they're financing? So for example, let's say, someone's paid down $30,000 or $40,000 of their principal over the last 10 years. They're still paying their payment based on that higher loan amount. So what happens when they actually refinance and drop that down? I mean, guys, if this is you and you're thinking that if we do have a downturn, we finally wake up one day from COVID and we realize, man, we're in a really big economic slump, forbearance is over, the hangover has arrived, and basically you're looking at, could you actually save yourself by paying $500 or $600 or $700 less by refinancing now? Brenda, is that an option for somebody like the scenario I just gave, like me, that bought, or refied 7, 8 years ago at 4.5%?
You know what, Todd? It all depends on how long you're going to be in your house, and like you say, how how many years you've paid into your mortgage
Let's
already?
let's say I'm going to stay here forever.
Okay. So if you started your loan 9 years ago and you've paid it down a good, a little bit, um, and you're at a 4.5% rate right now, and you can refinance to a 3% rate, chances are, and you're going to stay in your house for, well, forever, even 5 or more years, it's a great idea to look at the numbers. But what's most important with every single person that walks in the door when it comes to your money is, what's your goal? Do you want the lower payment because you're scared about paying too much, about the economy crashing and needing to lower your monthly bills, your monthly debt? Or are you looking at the big picture? Do you have some flexibility? So do you want to lower your term and save thousands and thousands of dollars in interest?
Yeah, I did a little scenario here. So if you finance $250,000 in debt for your home on a 30-year mortgage of 4.5%, over the course of the lifetime of the loan, you actually paid $206,000 in interest at a without considering your insurance or your taxes, because I don't know where you live. Your principal and interest payment was about $1,266. If you could drop that a point today, that same 250,000 by dropping at a point to 3.5%, you would actually save $80,547 in interest, turning that into a 25-year loan, knocking 5 years off, and basically your payment would be about $10 less a month by doing that. So, I mean, it is significant amount of savings if you're planning on staying in your house for a while.
It's very exciting. So exciting. I've helped a lot of people lately, young people, some of which that have just purchased their house 2 years ago. And just with that little trick, when they refinance, it's a win-win, because if they go from that 30-year fixed to a 25-year amortized mortgage, rates are basically 20 to 30 years when we say 30-year fixed rate. So you amortize that over 25 years. And instead of paying from the first payment, say $1,200 a month on the interest, $600 a month on the principal, you go to a 25-year fixed term, and all of a sudden, you're paying almost equal amounts to principal and interest, $900 and $900 from the very first payment. On the 30-year fixed mortgage, it might take you 9+ years to get to the point where you're paying as much in principal as you are in interest. And the long-term goal is always to get to where you're paying that principal down quicker than the interest.
Yeah, and again, I mean, for many of us that have mortgages, I mean, we might not have the luxury to move every 7 or 9 years, if we really do hit a slump with our economy. And there's also other things that are happening. I mean, what this phenomenon of not having enough houses in our marketplace right now, and the house prices really being high, chances are if you sell, you're going to get actually less and pay more for it. So it's starting to see where staying in the house, for somebody like me, seems like it makes a lot more sense, especially if I can grab that safety net of uncertainty, not knowing what's going to happen, and capitalize on these low rates. Brenda, what are you writing? Just give me an idea of, refinance rates right now for a 25 or 30-year mortgage.
So the refinance rates are very much ebb and flow right now. And basically, if you can get under 3%, that's fantastic on a 30-year to 30, 25 term, whatever, 30-year fixed rate, in the twos, anywhere in the twos. However, what happens is the banks can't keep up with all the volume. So what I'm seeing right now, this very second, is refi rates are a little bit up, and they'll come back down again once the banks catch up with the volume.
So refi rates are up to what? I mean, give me an idea. Are we 3.5%?
Exactly. It could be 3.25%, depending on the product, where maybe a few weeks ago it was 2 7/8.
But that's still amazing, right? So if you finance and you're at 4.5%, guys, and you can get a 3.5% refinance, I mean, that's something, if you're going to stay in your house, I would definitely look at doing that. You know, for someone being in this industry, you know, I don't know what's going to happen, but I know that if you can save some money and, you know, refinance and drop that payment, take advantage of a lower principal balance, my advice would be to do it. And if you can
Talk to
pay
somebody.
more, yeah, talk to somebody. Absolutely. All right, let's move right along. Let's talk about first-time buyers. You know, a lot of our, you know, the National Association of Realtors said that almost 40% of the mortgages last year in 2019 were from a millennial buyer. So obviously, there's a lot of first-timers that are entering the space and becoming homeowners. Let's give them some advice right now. If you're a new home buyer buying for the first time, Brenda, I know that there's a lot here in Maryland. There's a Maryland mortgage program. I mean, there's grants, and the cities have, you know, great incentives. Can you talk a little bit about what types of incentives these first-time buyers have available for them?
Sure. Things like programs like the Maryland Mortgage Program allows people to actually buy a home without having a lot of savings. They have a program such as 3% down, and then which is basically like a second loan with no interest and no payment. So that if you don't have that 3.5% down payment, and as long as your income is not like in the top 1%, for instance,
So
you
there are
can.
restrictions, income
There's
restrictions.
some, but it's not, you know, case by case. But it's not. They're pretty flexible, actually. Maryland Mortgage Program, but they have 3% down programs. For instance, they have $5,000 programs. They have some programs that are grants, but typically you're going to pay a higher interest rate. But the bottom line is, if you're renting and you don't have a lot socked away, there are definite options for you to make sure you've got your credit ready, and get some help in that down payment and to buy a house and get yourself in a better financial position.
So can there be co-applicants for these grants, or is it individual applicants only? So if it's a couple that is buying, you know, can these grants still work, or is it primarily just individual
Oh,
based?
no, of course. It's one to two buyers. Absolutely.
Uh-huh. And where
Mhm.
does somebody go to find information on that?
I think that your lender is the best source. And then there's also area home buying counseling classes that are highly recommended and usually required, almost always required, some type of home buying counseling if you're going to look for some assistance, down payment assistance.
But you say with down payment assistance, they're going to pay a higher interest rate.
Not necessarily.
Okay.
For instance, the city of Baltimore offers lots of different kinds of grants that are 20% forgivable a year. So if you live in your home for 5 years, then you do not have to pay back that, whatever that grant is, whether it's a $5,000 community development block grant, um, or which is a little bit more of an income-based grant. But then there are others that are not income sensitive at all, like depending on who your employer is. Hopkins has some programs. There's all kinds of things out there, especially in the city,
So
with grants.
they have live where you work grants, a lot of them, right? So the city offers, are they still offering that? And then the employers a lot of times will match that up to a certain amount of money. Are you seeing that
There's
still?
different combinations. Absolutely. Absolutely. Yes. Yes.
So what about you know, let's talk about customary charges, and I know, you know, there's a lot. You've got, you know, internet mortgage companies out there. You see like ads for Rocket Mortgage. I think they're like jumping into one of the largest loan originators in the nation. Um, you know, you've got banks, you have mortgage brokers like yourself. You know, what's the difference in dealing with each? And you know, what can someone, if somebody's looking for a mortgage, I mean, they talk to somebody like you, they talk to their bank, how do they know they're getting the best deal? or does everybody kind of across the board charge whatever the heck they feel like? Or are there set charges, origination fees? Can you just tell the audience about, what charges are like to originate these loans?
Sure. It's interesting. Everyone comes to the lender for the charges. And I have one charge, the mortgage origination fee, so that we can process and underwrite the loans. $1,245, for instance, in my case. And across the board, it costs a little bit of money to borrow money. That's the bottom line. And whether you go to a bank or a mortgage correspondent lender or a mortgage broker, it should be pretty similar. It really should be similar. We're highly regulated. And as well, same for interest rates. We're all on a very level playing field.
So should somebody price it out with multiple lenders, or do they know, like if they're dealing with you that, and I know there's no price fixing and things like that. Everybody has their own rates, but should somebody, you said there's regulation. So is there a need for somebody to shop?
I think that it's fine to speak to one or two people, and you just have to ask the right questions and make sure that the person you're talking to is very experienced. For instance, with working with realtors. And if you're buying a home, you don't want somebody that's just sitting behind a desk kind of taking orders and doing a lot of refinances. You want someone that's actively out there working with first-time home buyers, repeat home buyers, loans of all different kinds. Sometimes the bank might not have as many products, like maybe they can't do a 203K renovation loan. Someone like, a mortgage person such as myself, a mortgage lender, not affiliated with any particular bank. I'm just residential mortgage services, for instance. I have a pretty broad spectrum of what I can offer.
So I guess then the proper question is, shopping products, not prices. So, like you just said, so
very much
there may be certain lenders that have those different, it's more understanding. I think what I hear a lot of times is, a lot of lenders, you have to fit inside that certain box, for lack of a better term. Everything has to be perfect, where we're not perfect. I mean, sometimes we have late payments. Sometimes we have, higher debt to income ratios. Sometimes our credit scores. So is what you're saying, in dealing with the lender, it's more important that you're just upfront initially with your circumstances or your situations to find out whether they have that product, or if they just can't help you. Is that kind of a better way?
The best product, the best fit, absolutely. Completely upfront. Absolutely.
Yep. Gotcha.
Give all the information you can, the more, the better.
Sure. Yep. So let's talk about, the rates, and the rates being low right now. And there's terms like rate lock, get locked in. What does that mean to somebody to get locked in? And, how long is a lock in, and what happens if they lock in and the prices drop? Can you just kind of tell us about, what a rate lock even means?
Right. Well, basically, it's price protecting your mortgage rate, interest rate, so that typically, if you're in a 30-day window and you're buying a house, you've got to look at locking your interest rate. You don't want to mess around, and it's going to go up and down a little, but typically, yes, it's timing. To answer your question, yes, you can once you lock. If you need to if rates drop a little bit, you can adjust, certainly, the interest rate. We often say if you do it for free, it usually costs a teeny bit of money, but nothing I say is necessarily always free. But if there's a significant drop, certainly you can take advantage of it. But it goes very quickly. If you're buying a house, once you lock in, typically it's important to do that before too long, because you don't want the rates to go up.
How long can you lock in for?
30 days, 45 days. There's 60-day locks. And you can go even longer depending on the type of loan. But you don't
Gotcha.
want to mess around once
Yeah,
you're, for instance, under contract.
sure. Yeah. Well, I'm just thinking, do you lock in before you even look? Is
No,
that
you
not
can't
the
do
right?
that.
Yeah, you can't. So you have to have that property. And so everybody is aware. I mean, you have to actually have a property that you're under contract with to lock in, right?
Right,
Okay.
exactly. So
Gotcha.
that's the timing part. Timing is huge.
Yeah, I got you. So let's talk about, what's the difference of using a bank? And maybe some of that's already answered, but what's the difference of using a bank versus a mortgage broker? Do you have more products than a traditional bank would have, a mortgage broker?
I go back to corresponding lender. Um, sometimes, sometimes it depends. It does.
Yeah.
It just depends on the what the situation is for the person buying the house.
So let's talk about the credit repair. I know one of your specialties, Brenda, um, is, we even had a conversation earlier today where you said you were, putting, I think you said a a square peg in a round hole. You're trying to make things happen and make things work and work on people's, help them to get their credit scores up. Let's talk a little bit about credit. You had mentioned that there is a minimum score that you kind of have to hit in order to be pre-qualified. Can you just give us what those scores are, and then we'll talk about some credit hacks that we know that you're really good at, and helping people get their scores higher.
There's some industry basics, basically, and if I'm depending on the type of loan, once again, a lot of people think they have 800 credit or better, but it's really hard to get that high in over 800 scores. 740 is in my world, considered in the world of lending, considered really good credit. Once you have 740, no matter what the type of loan is, you're probably going to be able to get the lowest possible interest rate, along with the other factors such as how much you're putting down, and what your debt to income is, what your debt is, versus your gross income, your total debt. Of course, the lower the better. The lower the risk, the lower the rate, as I was saying before. And then as far as going down the rate tiers, you know, I know that companies, lenders are out there lending at 580 plus. And when I say these scores, I'm just talking about the top two credit scores out of the three. I don't care about the third score. Um, I was working with someone recently who had one score over 800, one score over 700, and one score in the 600s. Um, and I actually was able to take them because they had one ding on their credit report, going to the little tricks. They basically had an old outstanding bill they had that was not never paid. They had no idea about, and I had them call the creditor and ask very nicely, if I pay this, will you please get me a letter of deletion, removal from my records, my credit report. And they made the call, got it taken off. All of a sudden, instead of a 700 middle score, I had two 800 scores and an 800 middle score. So in their case, they were buying a bigger house, higher risk loan, and so getting them back into the 800 level was helpful in getting the lowest rate. They actually did a first and a second mortgage. It was helpful all across the board.
So when you say the three credit reporting agencies, can we clarify what they are that the banks are that the underwriting is looking for? Because you know, a lot of people say their score on like a site like Credit Karma or something like that, and I know I've heard you say that sometimes that's not the most accurate. So what credit reporting agencies are the most important?
So once again, we're on the same ball field. It's TransUnion, Experian, and Equifax are the three credit bureaus that lenders use to lend. And depending on depending on what your thumbprint, what your credit snapshot looks like. Maybe you bought something and it only went on the Equifax record. Maybe you bought something else, it only went on the TransUnion record. It's very intricate, the way credit reporting happens and the way the way it all shakes out with these three different agencies.
So should people print or obtain all three of these prior to calling a mortgage person?
So it's really difficult to do it. The best way, and really the only way, to start getting ready for a refi or a purchase of a home is you've got to have a lender pull your credit. You've got to have that baseline pull, period. That is the only way to begin helping.
Gotcha. And as far as, but I mean, you can get these as consumers, right? I mean, we can get one of these free a year. Isn't that how it works?
You can get one free credit pull a year. Exactly. You can do that.
Because doesn't it actually hurt your credit when you do a hard inquiry from a mortgage person?
It just depends, Todd, on the situation. Did you buy a car and did you get your credit pulled 10 times in the last month and now you have a brand new car payment on your credit report? That can give you a little ding on your credit. Typically, unless you're getting new credit cards every month or something like that, if you're not abusing it, credit pulls, then 1 or 2 or 3 lender pulls is not going to be a big deal to your score.
Yeah.
There's so many other, not knowing what your credit profile looks like, that snapshot is much more dangerous than a simple credit pull.
Sure. So let's talk about, for the person that is trying to get that better interest rate. I know we talked about a couple hacks, and for those of you that are thinking of hacks as like hacking into we're not talking about that kind of stuff. We're talking about ways, secrets, or things that you can do to actually improve your score. And Brenda, a couple of these, so maybe we can just touch on a couple.
Oh, sure. There's do's and don'ts. Absolutely. There's 3 things when it comes to credit. There's the bottom line credit score. When it comes to interest rates, credit score is absolutely critical. How much you're putting down or what your loan to value of your home is, if it's a refinance, it can have an impact on your interest rate. The other thing is, what is your debt to income, your gross debt to your income? That can have a big impact on your interest rate. And again, the lower the risk, the lower the rate. And that is the bottom line. So as far as tricks and hacks, things that you can do that are helpful, and then there's some don'ts as well. The most common thing I hear people doing when they're getting ready to buy a house is, I've got some outstanding debt and I'm going to pay it off. I'm going to start paying off these 3 bills that that I've had on my report that I didn't even realize were unpaid. Guess what? Sometimes if you pay off an old bill, your credit score might go down. I wish I could just have the magic bullet for us all and say, this is what you're going to do to make everything better. But you've got to once again, start with that hard credit score, baseline pull. Number 1, get credit. Make sure you have credit. I have a 19-year-old son. I just thought about it. I need to make sure he has a credit card. And mom and dad or significant other, if you're going to like have someone on your credit card as a user, authorized user, please, and you want to build their credit, please make sure you keep your usage of that card way, way down, much lower than the limit. If you have $1,000 credit card limit, please don't ever charge and carry month to month more than $300.
That's 30%. 30%. Make sure that you're not any higher than 30% debt to that to that credit limit.
Yes, and that's kind of what I hear lenders talk about all the time. But really, again, it is so individual. It's like a thumbprint. When I'm working with someone and they're getting ready to buy or refinance, I can tweak things once I see that credit baseline credit pool and their history. I can tweak things like maybe they have 100% usage of their credit card, and I just bring it down to 95%, and I can get the 5 points I need to get them the better interest rate. There's little tweaks here and there, and I find without the professional use of my credit simulator or any lender who has, as a matter of fact, I'm not even sure that banks are allowed to use credit simulators, but correspondent lenders, brokers, we very carefully use this tool called the credit simulator, which will tell us exactly, tell you exactly what to do, how much to the penny to pay something down, or open up a new credit card, or what the exact action is to improve your credit score to get you in that better bucket in order to get the lowest possible interest rate.
I even heard where somebody actually called the credit card company and actually got a higher credit limit so that they owed that, less than that amount of a balance, by bumping that credit score. I mean, that credit limit higher, it actually helped their score. So.
Right. That's an idea, and it's a good practice to keep in touch with your creditors and your credit card holders and try to keep increasing, ask them how you can increase your limit. I've found it doesn't have an immediate effect necessarily. If you're trying to buy a house in 90 days or 30 days or 60 days, however, it's a good long-term practice. Keep trying to get those credit limits up for the long haul.
And this is good advice no matter whether, because what I hear you saying is even if you have a 700 credit score, which would be good for borrowing, it still might make more sense if they could get it up to 740 or 750. So these things aren't just for people that have had credit issues, but it's good advice for people that are in that higher, score bracket that want to get even higher to get better rates, correct?
Yes.
What else?
Okay. Going back to start way ahead. Don't wait till you're ready to buy a house. Start a year ahead. Talk to a lender. Start planning. Figure out what your credit looks like. Where are you? You never know. There's always surprises. I run into surprises all the time. People that are outstanding citizens, well off, or whether it's someone just starting out with their first job who's just got an offer letter and they've got their first 2 pay stubs. You never know until you do that actual credit pull. So start out early. Never, ever, ever pay anything late. Always put your, this is a big important thing.
The minimum.
Take your credit cards. Take 2 or 3 of them and keep them open. And make sure you have the minimum payment on a monthly automatic pay plan. I cannot tell you. I think we all have. I've made a late credit payment over the years, credit card payment, for whatever the reason, in my history. And one thing like one late payment can really ding your score. It can have an effect.
Yeah, because they're reading into it. Is there something going on that your income's changed, or is your dependability weakened, or lessened? So yeah.
Right.
We've all been late though, but that's good advice. So make sure that you're setting up those minimum payments so that they hit on the actual due date, and then you'll never be late, right?
Right. And what's really helpful with keeping your credit score up is please keep 2 or 3 active credit lines open, revolving credit, not your car payment, not your house payment, that revolving credit, 2 or 3 cards open, please. I cannot tell you how many people they pay off their debt. They're in a great spot. Maybe they're great career. The kids are grown. They're whatever. And they close out all their credit cards. Well, you really need 1, 2, 3 open, active, revolving lines of credit that you use and you pay off to keep that
So
score up.
just so everybody knows, you're going through the buying process, and when is the when are you in the clear as far as getting that final clear to close? So somebody's settling, um, it's Tuesday, they're settling on Friday. Is their credit report being pulled between now and Friday?
Anymore, especially with COVID, don't buy your furniture. Please don't buy a new car. Especially if your debt to income ratio is tight. Just try not to take out any new credit until after you've closed. Really,
Yeah.
ideally, take a month and then start spending money again
Can
after
they
you
can they
close.
can they pull your credit to see if something's changed the day before settlement?
Yes,
Do they
yes.
do that in most cases?
Usually it's a few days we check, and sometimes even after closing.
You were telling me that the other day. We were talking about, that can affect them in actually selling that loan, right? A lot of people don't understand. You go to somebody to get a mortgage, and then all of a sudden the coupon book shows up or the bill comes and it's a different company because your mortgage has been sold. And you were telling me that basically they will pull your credit, I guess, before they actually sell it, or maybe that's a requirement of the purchaser.
Mm-hmm.
Um, and then they find out that your scores dropped, or you went out and you bought all this stuff and now you become more risky. So as a result, it can prevent them from actually selling that loan, right?
Right. It could cause a problem. Right.
Yeah. Doesn't have anything to do with the borrower, right? They don't go and repossess that house because their credit score changed a week after settlement, but but they are still looking at you as a borrower, um, even after you sign the deed.
Yes. Be cautious, be conservative, save your money before, during, and as much as you can after.
Yeah. All right. So give us some closing tips. So there's some great information here tonight. I know there's a lot to talk about. We could talk hours about this, and everybody's situation is different. You referred to it as a thumbprint, but just give us some final parting thoughts.
Well, sure. The best thing is make sure that you are talking to an experienced professional and start early. Um, if I personally try and treat people as if they were my own son or daughter, or family member, and get as much information as I can from them so that I can truly make sure they're in the best possible place. Um, Sometimes a little tweaking here and there really helps, and I get that ability to do so with added information, whether it's debt to income related, credit score related. Sometimes there's a little tricks we can pull in with um, even home value versus your loan. But it's all about information exchange. And I've heard a lot of people complain that their lenders weren't responsive, and just didn't really hear what their goals were. You really, it's a very personal, it's a very individual thing, and everyone has a different story. Everyone has a different story. So we as lenders take that information and try and absolutely make sure we put you in the safest, most comfortable position. Don't ask me what you qualify for. I ask you, what is your monthly payment comfort zone? That's the bottom line.
Let's talk about money down, because you had mentioned giving advice to your son or daughter. And, we both have kids, and, everybody wants to jump to the chance to purchase a house. But when we're looking at, some of the numbers, the real numbers, when they were talking about the housing crisis in '08, I think the, I think that the foreclosure rate was somewhere around 1 to 1.5%. of the mortgages were being foreclosed on. And some of the predictions through COVID that were in, some of these people are, experts are predicting that we could be 3 times worse than the '08 crisis with foreclosures. And so many people over the last, decade have been relying on seller concessions for money down. They're not putting any money down. They're, stretching themselves. They're dependent upon 2 incomes to, in some cases, to make those mortgage payments. And what happens is, one loses their job, they're already in forbearance, and, the rest of the story. So, what do we talk about money down and being prepared? Should people rent longer and save money and put more money down?
We the lending environment, the lenders look at renting as kind of throwing money out the window. There's just not any benefit or gain.
But Brenda, where's the benefit in getting a mortgage and being foreclosed and having bad credit for the next 10 years? I mean, what's the, and I'm just asking, I mean, what's the advice? Because, I come from a background where, I had to save money, I had to work hard. And, if you have to do whatever it is that you have to do to put yourself in a better position, I just see so many people are buying houses and they don't have the money down. They don't even have the money to pay for a new furnace if it goes bad. So a $10,000 expenditure in their brand new house that they bought. So, I guess kind of, where I'm coming from is, we hear from a lender's world, and I'm not picking on you. I'm just talking about, some good ending conversations here to our back and forth. But, we hear a lot of times where the lenders are saying, just go back and, you don't have any money down. That's all right. Just go and ask the seller for cash back. And, they're getting the seller cash back and they don't have any money. And I just wonder whether we're doing, whether we're giving the proper advice, or would the advice to your kid be, what, stay home as long as you can, save as much money as you can, or rent a house hack, share your expenses and save. Because, I come from a belief that I think that we have some really difficult times ahead. I think we got some big financial times that we're going to have to overcome. We're writing, it's a different topic, but we're writing debt in an enormous, alarming fashion. And we're kind of propping everything up with debt. And I'm afraid one day that we're going to see, this come crashing down, and that we're not teaching people the old school method of save your money, put down money, make sure you're in an equity position that if anything hits the fan, that you'll be able to sell that house and, really be in an equity position to get out from underneath of it, so it doesn't crush you for 10 years of having a foreclosure on your record. But anyway, that's, guys, you will have to decide that. We thank you so much for being with us. Thank you, Brenda Evans. We're going to give you a second here to let everybody know, if you're watching this on YouTube or Facebook, or you're listening on your favorite podcast channel, Brenda, we will make sure her information is on the show notes wherever this is published. But Brenda, how do people get a hold of you?
Brenda.Evans@rmsmortgage.com.
That's awesome.
Brenda the lender.
Yeah, Brenda the lender. And how about a phone number?
410-979-4464.
You go.
Todd, thank you so much for having me this evening.
Yeah, you're so welcome. And guys, we love to serve you, and we love bringing you great content and information. If you're watching this on your favorite podcast channel, if you don't mind hitting that follow so that you can get more great real estate content. And certainly if you're watching it on YouTube or Facebook, if you would like our Sachs Realty Facebook page and subscribe to our YouTube channel and hit that little bell, we appreciate you and thank you so much. You guys have a great night. Talk to you soon.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.